Hey everyone, I want to welcome you to this episode of the HXPodcast. First, I want to apologize. We haven't been as active the last couple weeks. There's two reasons. Number one, we've been working on a new series and promotion and campaign that's been taking up a lot of our time. Number two, I also broke my ankle about a month ago, so that slowed me down a little bit and made things a little bit more difficult. But I'm walking, I'm around, I've been active the whole time. But again, I think you're going to see some more stuff coming out of us here in the coming weeks, and some really exciting stuff going into September. For this episode, what we're going to do, I thought we'd actually just talk a little bit about what's happening in the stock market right now. We normally don't do this. We usually try to have a guest on and go through what's some evergreen, some bigger picture kind of things. But I think clearly with what happened over the weekend and what happened on Monday, people are very interested. We've seen volatility like we haven't seen in over 2 years. We saw some record numbers coming out of Japan, coming out of the VIX, et cetera. And I thought it would be useful to talk about what's going on here because I think that there is a really interesting narrative underneath the sheets that is getting picked up a little bit in the media, but not very much. So let's start first with what's going on. So what I have here, I've got a chart of the S&P 500 across the last year. I'm sure you're familiar with this. We're going to use this as a proxy for the overall stock market. We had a sell-off that began last July. I'm going to expand the chart a little bit to the beginning of July. After a really good 2023, we had a sell-off that began in late July, ran through to October with the S&P 500 bottoming at about 4,100, 4,117, and then it just absolutely ripped almost in a straight line till July 10th. And if you remember, in July 10th, that's when we got the good CPI print. We got the idea that finally the Fed was going to be able to ease a little bit. And really, what's interesting when you look at this chart is look at, we got through the 50-day moving average on the S&P 500 on November 13th. We barely were below that 50-day moving average for almost any time. You can see here, that's the 100-day moving average that I'm pointing to. But the 100-day moving average, we never went below it at any point. The 50-day moving average, not only were we above it the majority of the time, we were well above it. So it wasn't even that we were skirting along it. We were 2 to 5% above it. This tells you this was a very one-way stock market. And we're going to come back to that in just a bit. So what happened here recently, we essentially had what we would call a blow-off top in early July. You got the inflation number. The market really liked it, so the Fed's going to be able to ease. And what happened was we saw with that movement away from, okay, the Fed's trapped, rates are going to stay higher, there's no kind of escape out of this. The entire perception moved very quickly to, okay, we can get to a soft landing. What does a soft landing mean? It means that we can have good GDP growth with moderate inflation and allow the Fed to ease the pressure of interest rates. So what we saw right then was a snapback in a relationship. And that relationship is the large caps relative to the small caps. Now, people talk, and just so those of you don't know, the U.S. stock market, the broadest index is called the Russell 3000. That's the 3,000 largest companies traded in the U.S. That's broken into the Russell 1000, which are the 1,000 largest, and the Russell 2000, which are the 2,000 smallest out of that 3,000. We don't spend a lot of time thinking about the Russell 2000 or worrying about it. And here's the reason why. The entire Russell 2000 makes up 5% of the market cap of the Russell 3000. If you took the revenue of all of those companies, or more important, the net income of all those companies, the net income of those companies is not equal to the net income of Apple by itself. So, people talk about them a lot because it's a lot of companies, and admittedly, it's quite a few jobs, although not that many more than the Russell 1000. But what happens is frankly, we don't really care all that much about the Russell 2000 because it's just small relative to the overall market, to the overall economy, et cetera. But what happened back in early July is the Russell 2000 broke out. The Russell 2000, the criticism of the stock market had been, oh yeah, the market's up, but like if you look at the equal weighted, so this chart that we have here is the S&P 500. This is the cap weighted. Here I'm going to pull up a chart of the equal weighted S&P 500. This is called the SPW. You can see that this was up a lot less through January. If we go January 1st to even slightly before the peak or early July, it was almost flat. It was up 2-3%. And if we look at the Russell actually was also flat. If you look here, the Russell 2000 was at just about 2,000 at the beginning of the year. And if you go into July, it was at just about 2,000. And then you see this huge spike up in it. At the same time, and I'm going to use an ETF here. This is the double Mag 7. So at the same time, you can see here, this is back in July. Look how the Mag 7, this is on July 10th. Look how the Mag 7 just got crushed. Okay, so we began to see this rotation in the market away from the largest stocks and into the smallest stocks. Now, this fundamentally by itself is actually quite bullish, because what it means is that it's not just about a dozen large stocks. It was broadening out. And you can see it here. This is the market cap weighted. The S&P went down because those stocks were going down. But if we look at the equal weighted SPW, look at here, it actually didn't go down. It went into a new high as we went into early August. So that brings us into the beginning of August and what happened here over the weekend. So the first thing that happened, so I guess what I'll say is this. There are two things I want you to think about. Number one, we were in a market that was up a lot, one-way market for a good long time, and there really had not been any corrections. It was all the flows were very one-way. That's the first thing to consider. And it had gone on for 9 months straight. Number two, we had just seen a broadening out of the market that was very, very bullish as we went into the beginning of August here. That was somewhat negative for the market cap weighted indices, but bullish for the overall market. So it was actually a pretty constructive setup. And then we hit this jobs report. And so what you remember last week, we saw some sell-offs in the beginning of the week, and then the market rallied. Those sell-offs are these sell-offs basically right here. Then the market rallied, and then the market got slammed on Friday. So what happened on Friday? This is actually very interesting. We got the monthly unemployment jobs report from the Bureau of Labor Statistics. And I'm going to pull up a couple slides here. This is the headline. U.S. hiring fell sharply in July, an unexpected setback for the economy, stoking recession fears. And if you go through here, it says that they did 114,000 jobs were reported in July, 35% fewer than expected, and unemployment was the highest since October 2021. So with the market already in this correction phase off of those July blow-off highs, you can think sort of the market when it's correcting, it's like it's beginning to slide downhill or get to the bottom of a hill. If it's a slippery hill, just a little bit of a push, and it can push the market very quickly. And so what happened was this jobs report coming in lower than expected essentially pushed the market in this corrective phase from what was a relatively, constructive phase. We were right here. We were holding this 50-day moving average. It just pushed it right through, down towards the 100-day moving average. Now, let's talk about this jobs report, because I think there's a very different narrative here than what people were talking about. What was interesting about the jobs report is there were very serious weather events that happened in July. Hurricane Beryl. It really impacted Texas. People were without power for 2 weeks. The BLS in the job report, the Bureau of Labor Statistics, went out of their way and actually wrote this, and we've got it pulled up here. This is from the BLS website. Hurricane Beryl. Hurricane Beryl made landfall on the central coast of Texas on July 8th, blah, blah, blah. Hurricane Beryl had no discernible effect on national employment and an unemployment data for July, and the response rates for the two surveys were within normal range. So the BLS stepped out and said, hey, this hurricane didn't have an impact, okay? So on the face of it, when people first looked at that jobs report, they just said this just must be a bad jobs report. But let's go through some data here, okay? There is, in the BLS data, there's a whole bunch of different categories. If you actually pull up the report, I mean, there's like 100, 200 pieces of data in there. In there, there's actually a question in the questionnaire. People who say they could not report to work due to weather. Okay, this is a chart I have here from MarketWatch, and this actually shows you how many people in July said they couldn't report because of weather. The number was 461,000. Okay, what does that mean, 461,000? The average since 1976 is 50,000. So we had 9 times more people say they couldn't report to work during the month than normal. And you can look at this chart here on the video, like it's just crazy what this is. So it's a little unusual that the BLS would say it didn't have an impact, because here we clearly see a potential impact. The second thing that happened in that number was the unemployment rate ticked up, okay? And this has been concerning people about the unemployment rate. And so you can see here with the unemployment rate, this is actually from the White House talking about it. What they point out is that, and I'm going to highlight it here, the prime age labor force participation rate ticked up to 84%. That's the highest it's been since 2001. So what you had here is you had a stock market that was up and to the right, that was waiting for a correction. It was going through a healthy correction, one where, although the market cap weighted indexes were coming down, everything else was going up. So that brings those indices down. But as you're sliding down this hill, it doesn't take very much to kind of push you, and you slide a little bit more. Like I broke my ankle, by the way. I was going down the hill. And this jobs report that was a little bit murky because of weather and the participation rate really is what kind of punched the market in the balls right here. Okay. So what happened over the weekend, though, is the market got kicked in the balls, and really slid. And this was the crazy stuff that we saw happen over the weekend. So what happened over the weekend? What happened was we began to see an unwind of what is called the Japanese yen carry trade. What the hell does that mean? Well, many of you know, actually, this you won't know, I was a Japanese major in university. I lived and worked in Japan. I don't speak so much Japanese anymore, but I know the Japanese markets very well. What's happened is, out of the 1980s and that whole bubble they have, the Japanese have kept interest rates at zero for basically forever. I'm going to see if I can pull up here, central bank. Here's the Bank of Japan central bank rate. Okay. We're going to pull up the chart here, and we're going to go back. Okay, so there you see it's at negative 0.10, negative 0.1%. Okay, so you're getting paid to actually borrow from the Japanese bank. This is how they try to stimulate the economy. Here's it going back. This is as far as this one will let me go to 2007. It basically has been, less than 0.25%. So what happened is recently the Japanese central bank, because of inflation, the same things that we've all been dealing with, has said they may go and raise the rates a little bit. And what happened is over the weekend or last week, the Japanese central bank, and here's another chart that I'm showing the BOJ rate increase, the policy rate. You can see here on August 1st, they had gone from 0.10 back in June, July to negative 0.10 to 0.10. Again, we're not talking 10%. We're talking 1/10 of 1 percentage point to 1/4 of a percentage point. So that, though, is a tiny move. Just think about how small that move is. But it's important because we hadn't seen any moves in this rate, and this chart actually has it here, any moves in this rate since 2009. So what the Japanese yen carry rate is you have very sophisticated financial operators that have been going out and borrowing in yen, where, remember, up until recently, I was getting paid a little bit to borrow from the government. That's fucking insane. And then what they were doing is they were going out and investing that money in higher yielding assets. By the way, if you look at the 10-year, 10-year U.S. government bonds, I'm just pulling that chart up here. Those had been yielding, I've been yielding closer to 4.5–5%. The Fed funds rate, which is the very short-term rate, has been closer to 5%. So an easy trade. Here's the Fed fund rate. We're putting the chart up here. That's been that's the wrong one. But hold on one second. FDTR, Fed funds target rate, upper bound. Here we go. It's at 5.5. So what if you're a sophisticated player? What you could do, and here's the chart across the last 5 years. You can see that we were near zero also. We were at a quarter point, just like Japan is now in March of 2022, and it went all the way up to 5.5%. So if you're a sophisticated player, what you could do is you could borrow at 0 and invest at 5 and keep the 5%, okay, and lever that up big time. Now, a lot of investors were doing this, but I want to make a couple of important points. That trade can only be executed by some of the most sophisticated investors in the world. It's not like you can go out as a retail investor and say, I'm going to put the yen carry trade on. So I think there's a real disconnect about perceptions about this trade. Meaning that many people have been calling this out. They've pointed to the rally in the Japanese yen recently. So I'm going to pull that chart up right here. Here's the rally in the Japanese yen. You can see here the yen. This is the cross rate went from 0.006 to 0.0062 to 0.0069, about a 10% move there. The rally in the yen, and they said, oh, people have all this leverage in this Japanese carry trade. When this unwinds, it's going to be terrible. It's going to be this flood of unwind that goes through the market, and everything's going to crash the market. I have a lot of problems with that. Number one, these are the most sophisticated operators in the world. They know that there's a risk of this unwinding. Let's talk about the mortgage crisis. The mortgage crisis was a situation where something could unwind and could crush the market. But the mortgage crisis was put together by millions of people like you and I going out and making these small, unsophisticated decisions that all led then to a giant problem that was being governed by unsophisticated operators and a very diverse group of operators. When that unwound, that couldn't really, there were no risk controls for it. For the Japanese yen carry trade, guess what? These major financial institutions, they knew what they were doing. They actually knew that there was a risk here. The second, let's be clear, is that the yen carry trade, we just went from it costing us 0.1 of a percentage to 0.25 of a percentage. That's 15 basis points. And it surprised people when the Bank of Japan did it over the weekend, but we're talking about tiny amounts. So the idea that the unwind of the Japanese yen carry trade was going to be completely out of control and just send this, it's not just a tremor, it's basically like an earthquake that would crumble all the other structures in the economy, is just stupid, to be honest. It shows a lack of awareness and understanding of how the financial markets actually operate. And that gets to the second point, is that what are the tremors that it was going to create? Was it going to break commercial real estate? We've spoken about commercial real estate before, and I want to say this. So let's talk about the tremors that it could break. Where do we have excesses in the economy? Well, we could argue that we have a bubble in treasury bonds, and the rates are artificially high. Well, we're actually, we've just raised those rates, so we can see that that's not necessarily the case, that we're fine there. Commercial real estate is the one that people are really going to, but we've pointed out, and we wrote a note about this a couple months ago, is that what people fail to understand, again, there is this, it's easy to point to a financial situation, but then not have an understanding of the operators and come to a conclusion. The view on the Japanese yen carry trade is that it could unwind, and that's not wrong, but it failed to understand that these were sophisticated operators. The view on commercial real estate is we had a bunch of commercial real estate that was sold and bought with high interest rate, lower interest rate loans back when office buildings were full. And now, post-COVID, office buildings aren't full, and those loans are coming up to be relent for, to be refinanced. Sorry, I couldn't come up with that word. To be refinanced. The problem that people have is, unlike the mortgage situation, where there were millions of individuals that were basically forced into the defaulting on their mortgage, these loans, there's only hundreds or thousands of them. First off, it's only a small piece of commercial real estate. It's B and C in big offices. The second is that the bank doesn't want to foreclose on the loan. The person borrowing doesn't want to be foreclosed on the loan, and the regulator doesn't want the loan to be foreclosed. So if no one wants the loan to be foreclosed, why don't they just renegotiate it, which is exactly what's happening. So I think this is a bit of a straw man. And so what happened, though, over the weekend, let's go back to that chart of the market. This happened over the weekend, or happened last week, the Bank of Japan move, and people just freaked out over the weekend. The first thing that happened, and this was very interesting, this is the first time we've ever seen this, is that crypto got fucking killed over the weekend. Look at this move. I mean, Bitcoin was already correcting with the NASDAQ, and Bitcoin over the weekend, that's August 4th, so went from 60,000 to at the open 50,000, just got crushed. Why did Bitcoin sell off on the Japanese yen? The reason is that these financial institutions have been financing their leverage with this Japanese borrowing. That leverage they could use to go buy US treasuries, they could use to go buy stocks, they could use to go buy cryptocurrency. So someone out there was going out and borrowing in Japanese yen and buying Bitcoin and buying Ethereum. And so what happened is, as you know, the crypto markets are open over the weekend. So the first thing that could be sold were the crypto markets, right? And so they went out and sold them off over the weekend. And then coming into the week, everyone freaked out about what was going to happen to the markets. The futures were almost like limit down, et cetera. And look at this huge whoosh we have in the S&P futures, okay? Or sorry, in the S&P. It opens down, I'm just pulling the S&P here. We were at 5346. It opens down 5129. I mean, it opens down 4.5%, something like that. So what happened was, let's go back again. We had a big steady market, a lot of people on one side of just one side of the equation here. We then have a change in regime where we begin to think that the rates are going to come down. Then we have the market begin to correct. We get a murky jobs report that then kind of now people start to say, well, the market's starting to correct. Is it telling me the economy is going down? Ooh, look at the jobs report. And then we get the Japanese yen carry trade freak out right on top of that over a weekend. Everything's limit down. People just freaked out. One other thing to think about, and this is absolutely true. August is prone to freakouts. I'm going to tell you a story. When I started my career as a portfolio manager back in, I started on the buy side in 97. I became portfolio manager in 98. I took a summer in August, and I'm originally from Phoenix, but a lot of my family's from Colorado. And this is 98, so there's mobile phones, but I got like a StarTAC or something. And we're driving around Colorado, and the market had been selling off a little bit. I remember this was when Mark McGwire and Sammy Sosa were going at it too. So we stopped at a bar and watched them do the home run record. But I started getting calls from my traders saying like Chancellor Communications is down $10, and there were all of a sudden all these stocks that had nothing to do with each other that were down 10, 20, 30, 40% in like a minute, and all that. And what was happening back then is we actually had the unwind of a giant carry trade. That carry trade was called long-term capital management. It was basically a hedge fund that was borrowing. It was fixed income guys that came out of Salomon Brothers. They had borrowed short-term at very low rates, but then they had bought long-term assets. But as the markets began to move against them, the borrowing got pulled away from them and they had to sell those assets, and it caused this waterfall to happen through the markets. And stuff like that, I'm going to tell you, often happens in August. I swear to God, because it's people are on vacation, there's less activity, etc. So August freakouts are very normal. So let's talk about what's happened. Where do we go from here? So what do I think has actually happened? Okay. We had a very up and to the right market, everyone on one side of the raft. We're going to come back to that in a bit. We begin to broaden out and strengthen, but in doing so, we begin to see a correction in some of the larger stocks. That got people a little bit nervous. Then we got a murky jobs report, which I'm going to go through it a bit, or I kind of already said it, I think is actually a false tell. And then we got this boogeyman that was out there about the Japanese yen carry trade came in over the weekend and everyone freaked out, okay? And we obviously saw the market freak out here. And by the way, what you want to know the measure of a freak out? Like if I use the word freak out, you're like, well, why do you consider a freak out? We have the VIX. This is basically the measure of the underlying volatility in the market. And we can go back to the VIX. Look at the VIX here, and I pointed this out. The VIX hit a high, intraday high of 65.88. We've got data going back to it's only hit that twice. It hit it during COVID, and it hit it right after Lehman Brothers went out of business. So I got to tell you, it's a bummer we only added 115,000 jobs last month and not 165,000, and the unemployment rate ticked up by 0.1, whether that really sustains itself or not. It's a bummer that the Japanese yen cost you 15 basis points more than it did before, but this ain't Lehman and this ain't COVID. I'm pretty damn confident about that. And so far, by the way, the market has been agreeing with us, okay? So let's look at what the market has done since then. The market has come back here, and you can see the markets begin to recover. So we basically have traded up. Although we traded up at the beginning of the day and traded down at the end of the day until yesterday, every single day the market started strong, including this morning in the pre-market, okay? So the market's beginning to recover. Now, one thing I want you to watch here. Let's go back to that jobs report, because people will say, they'll say, okay, well, maybe the Japanese, there's a lot of people out there, very sophisticated institutions that have come out and said three-quarters of the Japanese yen carry trade has been unwound. I don't fucking know. Who knows? But they've got good methodologies. Like I said, I'm not really worried about the Japanese yen carry trade. These are sophisticated players. It's a tiny move. Like we don't have great cracks in our economy. Some people will disagree with that. On the commercial real estate, they're just fucking wrong. So the issue is then, what are the perceptions of economic growth? If that jobs report of 115 means in September we do 50,000, look out below. We got a problem. We've got a real recession. I don't think it's going to do that. I think what's going to happen, and I had gone on Twitter and I had said, watch the jobless claims, okay? Because if remember this chart, I want to go back. It's so important you look at this chart. This chart is fucking amazing to me. This is this chart that shows people without a job but not at work due to weather. And look at that, 461,000 versus the what is that, 50 years? It's almost as long as I've been alive. All right, it's close to 50 years. 50 years, nothing has ever looked like this. So my argument was, when we get the weekly jobless claims, a number that no one gives a shit about because they really shouldn't, the jobless claims wouldn't back this up. And you know what happened yesterday on Thursday? The jobless claims didn't back it up, okay? And that's why the market ripped, and that's why the markets begin to recover, et cetera. So I think what you're going to see happen here is the economy's just fine. Liquidity is just fine. The yen carry trade was a momentary freak out. It's going to move its way through. And you're going to now you've got 4 data points in front of you. Or 3 data points. You've got 2 more jobless claims that are going to come in good the next 2 Thursdays. And then you're going to get a jobs report in early September that I think is going to show the coast is clear. And by the way, the Fed's going to go in and cut, in September, later in the month, they'll cut 25 or 50 basis points. And I think everything is just fine. So one question you might ask is, why does that 461,000 number matter? Why does it play through in the jobs? Well, let me just give you this answer. I got that data from very smart economists who know the BLS stuff backwards and forwards. They know all these numbers, and they're the ones that pointed it out to me. So I don't know the exact mechanics of how that plays through in the number, but I think what happens is if you can't show up for your job, you don't file for a new, you don't file a new job, or an employer doesn't show a new job. B, you maybe even are able to file for unemployment for that week or two that you can't show up for your job as a result of it. So I think, again, I'll lean on those economists that again, I've got probably a dozen of them that I follow, and 3 or 4 of them came out with that data, and it was pretty interesting. So, okay. So getting back to, what we have here with the S&P 500, what you're going to hear is this, and people aren't wrong. A lot of very savvy traders are going to say, okay, look, maybe you're right in 3-6 months. But the reality is that when we see this kind of sell-off, especially with this sort of VIX movement that we saw here, and here's the chart of the VIX again, and I'm going to go to this max chart, is that we almost always see some sort of retest. And let's go, I'm going to go to a chart of the VIX here that I'm going to go back to 2014. And I'm going to walk you through, we've seen a couple episodes like this, okay? Look here in September of 2015, and look here in March of 2018, okay? Let's talk about September of 2015. September 2015 was when the Chinese government surprised the market by devaluing their currency, the yuan, okay? A little shades of the Japanese yen here, right? So here's an article from back then. This article is from The Guardian. This is whatever. It's September of 2015, and they talk about this. So what happened is the VIX spiked. Now let's look at what the S&P did that back then. What I'll note, it's kind of funny that it happened in September of 2014. Like I said, or 2015. There's a rhythm to these things sometimes. So this is, I'm going to take the S&P here from the January 1st, 2015 to 12/31/2016, and let's look at here. Look here. Okay, so actually, this began before the VIX spike. Look at this. Look at this. This is amazing. August 20th. Look at what the S&P 500 does. It goes from 2,000 to 1,800. Okay, a lot like what we just saw. Now, what I'm going to show you here, though, what's kind of interesting is that it plunged way through the moving averages, much more through the moving averages. But this was that VIX spike right in August. Look what happened. We rallied for 20 days, we retested, and then we moved higher. Now, we went lower back in 2016, but there were some other things going on. But this absolutely is one thing that can happen here, okay? A similar VIX spike, kind of a slowing economy, although our economy right now is in much better shape. GDP in Q2 was 2.5%. The initial read on GDP in Q3 is coming in at 2.9. That can be revised. But again, in all scenarios, we saw a healthy bounce, a retest, and then a really healthy bounce. Now let's go back to the 2018 bounce in the VIX, okay? What I'm going to do here, what I'm actually going to do, I want to show you the VIX index, because I should have gone to the straight chart. Here it is. The August was the spike in the right when we said there's that spike in the whatchamacallit in the VIX. Now let's go. Let me just look here. I'm going to pull up the long-term chart of the VIX here. We're going to go back to that 2018. That was in March of 2018. Let's take a look at the S&P back in March 2018, and this was something that was called Volmageddon. Okay, funny name. We're going to talk about that in a second. Okay, so here I started it in 2017. Look, here's Volmageddon. Okay, now this one looks a lot more like what just happened, right? We were very extended from the 50-day moving average. We corrected through, and bam, we went right down to that 200-day moving average. We bounced all the way back, okay, or to right here. So in both these cases, we bounced, and then we went and retested a couple months later, and then we churned for a while before we went higher. You could ignore, I mean, this part here, 2018 later on, that's a year later. We're not going to worry about a year later for right now. So this is what could happen. What was Volmageddon? You can look it up here. But here's Bloomberg's story: the day that the VIX doubled tails of Volmageddon. Basically, what happened was there was some internals in the market that caused a spike in volatility. Some very, very technical stuff. I kind of don't care. What I care about was look at the setup, how similar it is to right now. So look at this chart here. So we're going to do this. This is back in 2018. Look at this. Okay, that's a great setup. This is okay. Look at that chart right there. Okay, that's 2017 going into early 2018. Now let's go look at the S&P 500 right now. But I'm going to take out what just happened. Looks the same. Very, very familiar. We had a long, it was up for a long time, and then it's very extended from the 50-day, the 100-day, the 200-day. Now look what happens next. It comes down just like it did in 2018. So I'm going to argue one of two things happen here. I just showed you one of them, and this is what the cool kids think is going to happen. The cool kids are saying there's going to be a retest, and that we're going to go into, we'll at least retest these levels and maybe even go lower. Okay, look, the yuan devaluation, Volmageddon, both of it happened. I'm not going to disagree with that. What I will tell you though is in both those retests, we moved much higher before the retest, and we moved higher after the retest. But I'm going to give you something else. I think this might just be a head fake, okay? Because look how well we've recovered from that damage. And I'm going to give you, those of you who know me for a long time and follow my stuff know this thesis that I have about the markets. And it's going to sound kind of cheesy, but I really want you to listen to it, okay? A lot of the movement in markets in the short term is about potential. And what I argue is that the market is like, we're all on this raft, the owning stocks, and we're going down a river, okay? And it's in a canyon. I'm from Arizona. So we're going down the Colorado River and the Grand Canyon. And all of a sudden, as we're moving through the canyon, one side of the raft is sunny and one side of the raft is shady. And as we keep on moving through, people keep on moving from one side of the raft, the shady side, to the sunny side. Now, instead, we had 40 people on the raft, 20 on each side. Now, there's 30 people on one side and 10 on the other. Then what happens is the river can be going the same speed. The river can be hitting the same rocks that it was hitting before. But now with 30 people on one side and 10 people on the other, it hits the rocks and it goes like this. It goes crazy. And so what happens is when you get this, and I'm pointing to the chart here, the extension from 50-day, you get this overbought for so long. Everyone was on one side of the raft. Everyone was on one side of the raft with the Japanese yen carry trade. Everyone was on one side of the raft with the Mag 7. It doesn't take very much to really upset it. And it seems like the raft's going to go under when you hit that not very big rock. But it seems like it when the raft is going like this. But here's the point. People move to the other side of the raft. The Japanese yen carry trade gets closed out. Interest rates start to come down. Inflation's coming down. The jobs will be just fine. People rotate out of the tech stocks into other stuff. And we rebalance the raft and we continue down the river. Okay, that's what I think is likely to happen here. And while V recoveries from that kind of VIX are the exception, not the rule, that doesn't mean that they don't happen. They have happened in the past. And so I'll bring up one last topic, which I do think of. This one I owe to Keith McCullough from Hedge Eye. He does incredible work. Keith has a fantastic product, and I encourage you to check it out. And Keith really, what he does, this week I wrote an article about William O'Neill and how to, this great book. I literally happen to have a copy of it right here, How to Make Money in Stocks. And one of the things he says is it's important to understand what kind of market you're in. And what Keith does with his service, and it's a little different than ours, Keith breaks up the market into 4 quads. Depending on what's happening, the incremental change in interest rates and growth and all of that. And Keith's point is that we right now are in quad 4. That's a period where we see slowing growth and lower interest rates. And the thing about quad 4 is it doesn't mean that the market crashes, but it means it gets choppy. Before we had been in quad 3, we had been in, and you can go quarter to quarter from one. You've been in accelerating growth and stable interest rates, all this. So now I do think that it's going to get choppy. But what I'm going to tell you is this, and I'll give you the last piece, and this is our strategy. Those of you who are active trading with us know what we do. On July 10th, we put out a note that was basically the equivalent of sell everything in your trading accounts. We said, this is just, I've been here before. It was on the Monday, whatever that was, the market top the next day. We had taken our trading product, which had as many as 15, 16 names, down to 4, okay? And then I basically said, I don't know what's going to happen. I just can't find ideas. Everything's too extended, et cetera. And then the market started selling off. And since then, we've added 8 ideas. I basically added 2 a week. Usually we add 1 a week. And part of my strategy was this, is I looked at it, and as the stocks were selling off, I was finding companies with great fundamentals that were beating numbers, that were in great shape, that were just getting hit, that were getting materially oversold. And this was happening not because of what was happening to the stock, which is what I had to rely on earlier in the year, but because what was happening to the market. So what we did is we said, I kind of did this. It's a simple rule. Every 3% down in the S&P 500, I'm going to add 5 stocks to that portfolio. Okay, that's not exactly what we're doing. So if it goes down 3, we add 5. If it goes down 6, we add 10. If it goes down 9, we add, it's probably closer to 4 is kind of what it ends up working out to be. You could say, well, that's just averaging down. That's a fucking terrible thing to do. Well, it's not if you've got context about the economy, you've got context about what's going on with the companies, et cetera. The other thing that's happening is as you get that statistically oversold, even in a bear market, the market bounces. In 2022, that product with only longs produced a 9% absolute return for our investors versus negative 20 in the S&P and negative 30 or whatever the hell it was on the NASDAQ by doing intelligent tactical trading. So that's what we're doing here, because I think, a lot of people are saying, I'm just going to wait. I'm just going to wait. I'll wait for everything to clear. I won't wait for all clear. And there's nothing wrong with that. There's nothing wrong with that. I think you're leaving an opportunity on the table. That's why we step in and we say, if I'm willing to have 25 stocks in the portfolio, now I've got 11. We would have 12. One of them went up a gajillion% off of earnings the other day. I'm willing to buy more as we go down. Again, because of the backdrop, it's not done in a vacuum. It's done in a very tactical, well thought out way. So, look, I think that a lot of people are coming out panicky right now. I don't know if you saw Jeremy Siegel, who I think the world of Jeremy Siegel. He wasn't a Wharton professor of mine, but he's a very smart man, knows a lot about stocks. I don't know his macro views are a little less insightful for me, coming out saying on Monday we need to cut immediately by 75 basis points, cut by another 75 at the meeting. Those would be the largest cuts in the history of the Fed. And we're talking about an S&P that's off 5%, credit that's not moving. It was just fucking insane. You got people doing emergency briefings like, look, you should always be concerned about what's happening in the world. We are in a slowing growth environment. We have high interest rates. We have a problem in commercial real estate. We had a problem with the in-carry trade. But remember, okay, the trend is your friend. Follow the trend in both economics and in the stock market. It doesn't change on a dime. So look, in 3 to 6 months, I may be coming on here and say, we're in a recession, we're not doing anything, et cetera. We're not going to say that now. Basically, we were at all-time highs 3 weeks ago. GDP is accelerating. Rates are going down. This is when you keep your head and you plan the trade the plan. That's what we did. July 10th, we sold out. We sold basically everything. We felt that there wasn't anything to do. And we said, if the market comes in and there's no real change in data, we're going to be buying. And that's what we've been doing. And by the way, now we're starting to take some profits. A stock that we bought last week, we're going to sell today up 10% because they had blowout earnings. So I thank you for joining me here on this special edition. As my video guy says, I say they're all special. We're doing something a little different. This time we actually did. And as always, follow us on YouTube, follow us on Twitter. We're on Facebook, LinkedIn. Hit us up with any questions. You can hit us at newsletters@hxresearch.net, and we appreciate your time and your support.